Hello everyone, it's Professor Reiko here again, and today we are going to start walking through our chapter on stockholders' equity. If you are in the KISO book, I believe this is chapter 15, and in the Spiceland book, I believe it is chapter 18. But either way, it covers for the most part pretty much the same materials. So let's get rolling here. So stockholders' equity, I mean, we're all familiar with the balance sheet. And if you look here, remember our balance sheet basically kind of sums up the accounting equation there. All right, so equity is just the difference between the assets and liabilities. So if you subtract liabilities from each side, you get assets minus liabilities equals stockholder equity. And that's why a lot of times people might refer to equity as net assets. They equal the same thing. All right, so stock, typically we're talking about common stock here, but we'll also talk about preferred stock some in this chapter. But stock represents equity in a company. All right, so stocks have the following rights: a proportionate share in profits or losses, the right to vote. That's mainly common stock. You know, if you are a common shareholder, you have the right to vote. And actually, if any of you have your own, Robinhood or TD Ameritrade accounts, and when your company, if you're invested, when they have their annual shareholder meeting, you'll usually get an email and they'll want you to vote by proxy. But actually, as a shareholder, you have the right to go to the annual shareholder meeting and vote there if you have the wherewithal to do that. Proportionate share in assets upon liquidation. It just means that the company goes out of business and they just sell their assets off. Technically, if they're going out of business, there's probably not going to be a lot left after they pay off all their debt. But if there was, you'd have a proportionate share in that. And then preemptive rights. This is another thing we'll talk about in the earnings per share chapter. But this just protects the stockholders from involuntary dilution of their ownership. So let's just say, for example, you own a company and I own 30% of the stock. Okay, so that's a huge chunk of the stock. I'm probably the largest shareholder if I own 30%. All right, so let's say you do not like my influence that I have with that large percent of the outstanding stock. What the preemptive right does, it prevents you, the company, from going out and issuing a bunch more shares and not allowing me to buy any, which would dilute my ownership interest. So if you went out and, let's say you went out and issued 10 million more shares, I would have the right to buy 30% of them, which is to maintain my ownership level. I don't have to, but I would have that right, and that's what that deals with there. All right, so some key terms with stocks, all right? So these first three all kind of go together, okay? When you see the stock description, these three will typically be laid out for you. So if you look at a company's financial statements, they'll have these, when in the equity section under common stock, they'll say how many shares are authorized. All right, so this is the maximum number they're allowed to sell, all right? They have issued stock, so this is stock that has been sold. And then outstanding stock is stock that is in the hands of the shareholders. Okay, so at first when you look at, stock that has been sold and stock that is in the hands of the shareholders, you should be thinking, well, that sounds like that should be the same thing, right? And then you notice the next sentence there says not all issued stock is outstanding, okay? So the difference between issued and outstanding. Now, a lot of times issued and outstanding might be the same thing. However, companies have the ability to go out and buy back their own shares. If that is the case, if they go and do that, we call it treasury stock, okay? But remember, if they go out and buy it, that stock has been issued, so it's still issued, but it is no longer in the hands of the shareholder, so it's outstanding. So anytime you these two numbers, issued and outstanding, are different, the difference will be equal to the amount of treasury stock that's outstanding, the number of shares. Okay, so that's something that we will see here in a little bit as we work into our treasury stock examples here, 2 or 3 videos down the road. All right, so just real quick, some basic accounting for this. Now, look, you should have done most of this in your financial principles class. So a lot of this might be review for you. So we'll go through some of this pretty quick, these first couple of videos. But some stock has a par value, okay, which is like the stated or face value of the stock, has no relation whatsoever to the fair market value of it. All right, it's just kind of an arbitrary number, typically pretty low. Now I've got some numbers in here, $5, and I'll have some 7 and 10. But like if you look at like Home Depot, I think Home Depot par value is 5 cents. All right, so it's just an arbitrary number that the common stock, they say, is the par value of it. All right, so if it's issued at par, okay, meaning the sales price is the same. Every time we issue stock for cash, we're going to debit cash, and we're going to debit cash for the sales price. Okay, so this is the sales price, or I'll call it the issue price a lot because we're issuing stock. All right, and then we credit common stock. Now remember, common stock is an equity account. All right, and so equity has a normal credit balance, and that will be at 5, which is the par value. Okay, so every time we credit common stock, every time we do it for these next videos, it will always be at par value. All right, so if we issued above par value, okay, so we're still going to have cash. It says, here we issued it at $7, still $5 par. So 7 is still the sales price, okay? So 7 is the new sales price, I should say. So we're going to issue at $7, so that's the sales price. We have common stock, which always goes on the books at par value. So now you can see we have a difference of 2, okay? And this is just additional paid-in capital, okay? And I call it additional paid-in capital common stock because, honestly, when I took this class, that's what we called it, and it's easy to abbreviate. I believe both books, Kiso and Spison, if I'm not mistaken, they call it paid-in capital in excess of par. All right, so I'm calling it additional paid-in capital. They're calling it paid-in capital in excess. Those mean the exact same thing, so I'm not going to worry too much about that. But once again, this is always the sales or issue price. This is par value. And then this essentially is your plug number that's catching the difference between the sales price and the par value. Okay. Now look, this paid-in capital account is also an equity account. Okay. Which means it has a normal credit balance as well. All right. So it would be right there in the balance sheet in the equity section right there with common stock. All right, so what we're going to do over the next couple of videos is look at different ways to issue stock, like if we issue stock with more than one security, if we issue stock for something other than cash, things like that, and then we'll get into treasury stock and some other things. One more quick thing I want to point out here. Sometimes you'll have stock that is no par, meaning there's no par value. If so, the cash and the common stock, so this journal entry right here, it would look like that, meaning there would be no additional paid-in capital. So let's say we had no par. This example here, let's say it was no par, issued at $5. We would put cash, we would receive the cash for 5, and we put common stock on for 5. And that, instead of this saying par value right here, it would just be the same thing as the sales price. All right. So there wouldn't be any additional paid-in capital. All right, so that's our first video, just kind of getting us rolling here. We'll pick it up next time and looking at a few more different scenarios about issuing stock before we move on to treasury stock. All right, so hopefully you're in good shape here getting started. Make sure you tune in next time as we'll start rolling into a little bit more details and getting some more examples in. So I hope to see you next time.